Welcome to Smart Investing Market Insights at TFNFinancialNews.com. I'm your host, Krista Das. The Federal Reserve's stance on interest rates last week helped spark a comeback in the markets. That comeback was welcomed when just the week before, investors were spooked on the news that more than 36 subprime lenders had filed for bankruptcy. Can the rally be sustained? Are there hidden factors that could again send the Dow spiraling downward? My guest today is here to answer those questions. Allow me to introduce Steve Lord, Senior Editor for Trend Investor. Steve, let me start by asking you your take on the Fed's decision to keep rates the same. In earlier months, the Feds were concerned about inflation. Does their move to keep rates unchanged mean inflation is no longer a concern?
No, actually not at all. They're still very concerned about inflation. I've been watching interest rates very closely, and I think actually the rally in T-bonds is probably about 95% over. In spite of the action this week with the Fed's removal of really what was a tightening bias, I don't think there's a lot of upside in bonds from here. What this really means is 10-year yields are more likely to go up than down.
Let's talk a minute about T-bonds. A survey from the Securities Industry and Financial Markets Association forecasts the yield on the 10-year Treasury note to reach 4.63% by the end of the first quarter and remain there until the end of June. Michael Decker, co-head of research with SIFMA, stated, quote, "In addition to slightly lower rates, the yield curve will likely remain inverted to flat through the first half of 2007, end of quote." Steve, do you agree with the association's assessment, and what might the implications of this mean to investors?
Well, first of all, no, I think he's being optimistic on rates. I think long-term yields are going to be higher than 4.6% by the end of this year. And the overall stance has many implications, but chief among them is the drag that this is going to create or place on equities right as corporate earnings growth is starting to slow. We've already started seeing that happen. We're going to be down into hopefully mid-high single-digit earnings growth in the S&P this year versus double-digit growth for the last 13 quarters in a row. Stocks typically rally pretty strongly when the yield on the 10-year bond is going down, and they face typically much tougher sledding when it's rising. However, it's important to note that an advantage to this happening would be that the yield curve would revert to a more normal shape. And this is especially true if traders push down short-term rates in expectation of Fed cutting later this year. If this happens while longer-term yields like the 10-year are rising, the inverted yield curve that we've had for well over a year now would return to normal.
So in general, aren't inverted yield curves regarded as harbingers of recession?
Yes, absolutely. Inverted yield curves are almost universally regarded as harbingers of recession. So anything that removes the inverted yield curve would be positive for the equity markets. You know, we look back to about the early 60s, and you go back and do the numbers, the lion's share of the S&P 500's net capital gains have taken place when the 10-year yield has been at least 65 basis points above really short-term money. That's 90-day yield, 3-month yield, stuff like that. The current yield curve hasn't been that positive in 16 months or so. So you could argue that historically speaking, the stock market would have to have a positive yield curve by later this year if it was going to rally strongly from here.
Steve, if the yield curve becomes positive, isn't that a sign that the market itself has moved toward higher inflation?
Well, it depends on how it happens. Obviously, if the markets begin pricing Fed rate cuts later this year and lower the shorter end of the curve, it could become positive that way. If they start selling T-bonds rapidly and raise the longer end of the curve, the 10-year, 20-year, 30-year end, it could mean, like you said, that they're beginning to discount significant inflation down the road. The Fed is not going to cut, so what we're going to do is sell bonds out and raise the long-term yields. So it depends on how it happens.
What do you think will be the most likely outcome for interest rates? In other words, do you expect the Feds to cut rates this year?
I don't know. I mean, I think one of the most important things we're seeing right now is the Fed positioned themselves to a stance where they can go either way. Right now, they've opened the gates to go up if they have to, if inflation stays sticky, or down if this whole housing problem really starts to snowball. The clear text out of Ben Bernanke's statement last week was, I want the flexibility to go either way. Right now, there's really no good indication of which way we're going to have to go. My own take is that if we do get a Fed cut this year, it'll be late in the year, probably near the second end of the fourth quarter, the second half of the fourth quarter, or into the beginning of next year. But it isn't a sure thing anymore. We used to think that the Fed was going to be cutting rates maybe by June or July. That's off the table. I don't think a significant easing phase is really in store until 2008, early 2008.
So what would you recommend investors do right now?
Well, obviously, if we do get a positive reversion into the yield curve, that's going to be very positive for equities, particularly large cap equities. And when you look at the sort of the way the market is setting up vis-a-vis the slower corporate earnings growth and some of the slowing, the muddy patch of the economy we're in right now, growth stocks typically have outperformed value stocks. So I think the best place for investors to be focusing right now is, unless they're willing, they want to play the T-bond market itself, is to stick with large cap growth stocks. That's going to be the sector that outperforms the rest if we do continue through this muddle patch and into next fall.
Thank you, Steve. We appreciate your being here and sharing your insights with us.
My pleasure.
If you'd like to find out more about Steve's newsletter, Trend Investor, you'll find it at taipanfinancialnews.com. Thank you for watching. I'll see you here again next week. Until then, have a great week. I'm Krista Das.